Steve Bryce, Chief Investment Strategist first at Standard Chartered, joins us on the show from Singapore. Steve, hi, morning. Good to have you on the show. First, let's analyze what the market is expecting from the Greece election outcome, and could it be a game changer for the direction that global equities may take?
We actually think it's going to be pretty critical in terms of what actually happens at that election, and therefore what the policy response will be thereafter. I suppose by a narrow margin our central scenario is still that Greece remains in the euro, at least for now, and that's probably very positive for risk assets in the short term. But over the longer term, actually, you can argue that actually Greece leaving would lead to very severe policy action coming from the centre, from the ECB, from politicians as well. So that would be much more sustainable from an economic perspective and from an equity market perspective. Admittedly, after obviously some nerves of severe contagion in the short term. But so those are the sort of two major scenarios that we see at the moment. But I think the action over the weekend probably helps the pro-bailout parties do better in the election when it comes at the end of this week.
Steve, do you think EU has simply pushed the can down the road? What they've done is that they've injected Spanish banks with money that will take care of near-term problem, but the long-term structural issues are still there.
Probably a bit of both. I think that the size of the bailout package that we've been talked about, 100 billion euros, is very sizable and much bigger than probably people had anticipated. So I think that's a positive aspect with regards to specifically the Spanish banking sector. But clearly there are a lot of structural challenges still out there. So the idea that this is the silver bullet that solves all of Europe's problems is clearly not the case. We still have a lot of problems being seen elsewhere. Governments still having challenges in funding themselves. Spain itself, for instance, debt to GDP ratio on this after this injection will go up to around 90% of GDP next year. So clearly a lot of challenges still to be addressed. So yeah, this is very positive from a risk appetite perspective in the short term, but we still need further action coming out from the authorities.
Steve, in a democratic environment, the German taxpayers, they've already pumped in about $700 billion into that EU fund, the EFSF fund. Do you think it's a matter of time Angela Merkel will find it difficult to really, get some ownership going from German taxpayers?
I think there's two things we should probably think about here. Firstly, let's not kid ourselves. Germany has benefited hugely from the single currency, so one could argue this is payback from almost a free ride from an artificially weak Deutschmark joining the euro many years ago. So that is something that really has to be taken into account. But the second thing is that if you're looking at German politics, it does look pretty fragile at the moment, but we do believe that ultimately the electorate in Germany is very strongly pro-Europe, sees this as very critical to its long-term economic future, and therefore, as long as we do see a move towards sustainable fiscal integration, and therefore people managing the debt that's being created rather than the debt we've got historically, but new debt being created, then I think this is probably going to be manageable. But that's a big if, isn't it? At the moment we're seeing debt levels still increasing at quite a rapid pace. So we need to see some signs that's occurring, and that will come through longer term pacts that still need to be negotiated.
Steve, what about the US? How strong is the probability of QE3 there?
Well, I mean, Bernanke last week obviously was, certainly didn't take anything off the table, but certainly didn't put anything on the table in terms of something that's going to happen in the near term. So our view is that we're likely to see an extension of Operation Twist when the Fed meets next week. They're probably going to hold off in terms of QE3, so keep the powder dry to some degree on that front. The data has clearly been weakening in the States and disappointing expectations. But Bernanke's view was that this was maybe a payback for strong Q1 data rather than something to be more worried about. Clearly they're going to be watching what's going on going forward. But I think from this perspective, we still feel that the US is in the muddle-through scenario. We're looking around 2% growth this year, which, to be honest, after a balance sheet recession, is probably something that we should be grateful for, rather than expecting us to resume going back to sort of 3.5% growth that we had been used to.
So Steve, at Standard Chartered, what are you advising your clients? Are you still advising your clients that keep it safe, keep it simple, still hide it in US Treasuries because they offer lower yield, but they protect you in a difficult environment?
We're actually generally advising our clients to add risk in this risk-averse environment. And basically the viewpoint is that we've seen significant devaluation of asset prices in the past 2 to 3 months. And we don't really believe that's really the way it should be. Certainly, if you talk about the US Treasuries versus equity aspect, when you're getting paid 2.2% dividend yields versus 1.6% on 10-year US Treasuries, it's difficult unless you believe in a deflation argument, which we don't. We believe inflation is a bigger risk longer term than deflation. Then it would suggest that equities are extremely undervalued. They give you inflation protection and they're paying you more cash out in the form of dividends. Obviously, if you're looking at Europe, the equation is even more skewed towards equities. So in that environment, we're looking for people to add risk. Most of our clients are underweight underweight equities at the moment, and we're suggesting that maybe they should increase that to at least a neutral weighting, if not overweight, in the coming weeks.
Steve, what is your outlook on India, and has that changed over the last 3 months in terms of what we saw from the GDP figure and the full year target now being sub 7% levels?
Yeah, we've been pretty cautious on India now for about 18 months. I mean, to be fair, we didn't expect quite the economic scenario that we're seeing develop at the moment for India, so that has been worse than expected. But we've either been underweight or neutral in Indian equities for the full of that last 18 months, and don't really see that changing in the near term. We had been hoping that the next move would be to an overweight, but that seems to be some way away now. The stagflationary environment, we've obviously got industrial production coming out this week. That's expected to improve slightly, but still very anemic growth coming out, less than 1% year on year in our estimation. RBI's hands are tied here, so they might get 25 basis points when they next meet, but we probably see that as the last cut. So it's a very challenging environment. I think we really want to see some structural reform coming through to get more bullish on India, or obviously the data move away from that stagflationary environment, and we don't seem to be close to either at the moment. So a relatively cautious stance is probably warranted versus other equity markets around the world.
Steve, let me have the other logic, and the other logic is global commodity prices have corrected. India is a net importer of commodities, and it's a matter of time. Money will move out of Brazil, Russia, and maybe Indonesia. It will go back to India and China because they are net importing regions.
Yeah, and I suppose I have seen obviously valuations come down to some degree in India as well. I'm not convinced, to be honest, the lower commodity prices is going to be sufficient to get India out of this situation. Clearly, it will help reduce inflation, particularly obviously at lower oil prices. But we saw oil prices rise on the back of stronger than expected data out of China over the weekend on both the import and the export side. So we're expecting oil prices actually to rebound from here and move significantly higher in the coming months. So that dividend that we're seeing over the last month or 6 weeks coming through for India may well be temporary as the global economy actually comes out of this soft spot and reaccelerates. So that could remain a challenge for India looking forward.
Steve, so for rest of the year, are you a dollar bull, and where exactly do you think the dollar index will move?
Well, obviously until we get some of this uncertainty out of the way in Europe, and the weekend was part of that adjustment process, we hope, dollar is still going to be seen as the safe haven of choice. But if you look at the bigger picture, we've been advising clients to reduce their exposure to the dollar rather than increase it at this juncture. And several reasons for that. One is we do believe risk appetite will come back. Secondly is if you look at speculative positioning on currencies, people have the largest long position, speculative long position on the dollar, very close to the largest short position on the euro. So any positive news on Europe or on the global economy generally could well damage the dollar in a significant way. Australian positioning is net short, which is the last time it was in the global financial crisis. So I think there's a lot of aspects there that suggest that the dollar may be peaking out here, and we're advising our clients to again average into Australasian currencies and also Asian currencies to some degree over the coming weeks as we see this peaking process end off.
So what is your sense in terms of what the Reserve Bank of India, that's the central bank in India, would do in light of slowing growth? And can we expect further easing from the central bank in times to come?
Well, we're expecting the June meeting to end in a 25 basis point rate cut, but then we expect the central bank to be on hold. Clearly, they're in a very difficult situation now. If growth were to slow significantly, I suppose, going forward from current levels, or to fail to recover it to any extent, then we'll probably see the RBI embark on slightly more aggressive policy measures. But the challenge in the short term, of course, is that inflation is still elevated, and if oil prices do rise as we expect, then any decline in inflation will be very gradual.
So, Steve, let's rate it in terms of preference. Your short-term idea, your medium-term idea, and then your long-term idea, which is a 3-year time period.
Okay, so I suppose in the shorter term frame, we would probably like corporate high yield. We feel that spreads are widening very significantly there, and that is a big positive for those searching for yield, obviously, but also then looking for spread compression. So either in the US or Asia high yield, we believe value has been created in that space. If we look at the longer term, I think we do believe equities are extremely cheap, both on a historical basis, but even more so on a relative basis versus other asset classes. Clearly, that's challenging in terms of one, it's challenging to sell this idea in the current environment, given the uncertainties we're facing. But historically, if you buy equities at current valuations, you've been rewarded normally on a 1-year time horizon, but certainly on a 3-year time horizon, the performance looks pretty good. And also, as I say, relative to other asset classes, that should be significant outperformance. The intermediate space is probably going to be the Asian local currency debt. So we see significant opportunities being created there. Asian currencies still may be a little vulnerable in the short term if we do get any negative surprises on the economic front or the policy front in Europe. But Asian currencies now, and Indian rupee fits into this category, of course. Kicking around the lows that we've seen at the end of last year. So value has been created there, and we do believe in the long-term appreciation trend for Asian currencies. Clearly, the Indian rupee, excessive weakness having been seen there. Difficult to see exactly when that's going to halt on a sustainable basis, but when the turnaround comes, the rupee will appreciate quickly and sharply.